Welcome back to the channel. I'm Foreman, and this week has been massive, at least in my portfolio in the markets. I'm going to tell you the UK stocks I've bought and what's been really happening in the markets as of late. And according to Google Finance, the FTSE 100 is up 0.46%, the FTSE 250 is up 0.76%, the S&P 500 is up as of this video of 0.95%, and guess what? I have massively underperformed. I've dropped by 6.64%, although I really have no bother about this. This does not impact my emotion in any way. If anything, it's more the opposite. You'd expect someone to be a little bit sad, a bit upset. Oh no, I've lost some of the value of my investments. But I see this as a discount, and if I had a cash position, I'd be even happier. After all, holding stocks is like holding a business. I know the underlying value of these businesses and how much they're going to grow roughly on their financials each and every year. So why would I then sell it at a lower price unless the story has changed? And if you like the video, please drop one of these to help beat that YouTube algorithm. So to start the week, we have Boohoo. Boohoo have had a little bit of news. Like last week, they had a promotion with Megan Fox, who has 17.4 million followers on Instagram. This week we've got Jack Grealish, and the amount of times my hair has been compared to his on a drunk night out is unbelievable. In fact, I've probably had more times being called Jack Grealish than he has followers on Instagram, which is 4.4 million. So one of us is exaggerating. But anyway, Jack Grealish is very well known in the younger ages and those that support football. And I think this is a very good match for Boohoo Man. Yes, sure, this is like 3 to 4 times less well known as Megan Fox, but it also accurately targets the consumer base of Boohoo a lot more effectively because Jack's audience is very much a younger age. Obviously, there are going to be some people that are older that know of him, but a majority, I'd imagine, that do know him quite well would be in the target audience of Boohoo Man. I see this as a positive. Although with the ongoing court case and how they've had to change up their lawsuits, or at least that's ongoing, so the lawsuit is ongoing, and they've had to change up the way they're doing sales promotions, I can kind of see that they are really trying to push more sales. Obviously, more sales is a good thing. You want to increase the volume, and overall you should increase the revenue furthermore. And as they said, the demand had dropped prior to their trading update, and then it seemed to be steadily increasing. However, the amount of push notifications I've gotten on my app for sales, I'm starting to wonder if they're really growing their revenue just through demand increases or whether because they're pushing out more notifications. Overall, this doesn't make me bearish in any way. In fact, I'm still bullish, but it does make me wonder. One, we really need to see the next trading update or the interim results to really find out what is going on behind the scenes. Although, and I think that is what really is adding to the fear, uncertainty, and doubt. Nonetheless, Boohoo is down 5.45%. If I had a big enough cash position, I would be buying a lot more. However, recently I'm now working in finance. I'm now swapping from a weekly to a monthly salary. This means that I'm going to be a few weeks without any income, and for someone that has weekly expenses, this is certainly going to be a little bit difficult to adjust to, hence no cash. However, my income has pretty much doubled, and I hope that then I'm going to be able to effectively use this and then invest more in the markets every single month. And I could probably still go out and drink because that's exactly the mistake that I'm probably going to make tonight as well. Regardless, I've bought an extra 132 shares of Boohoo. I've not sold any positions to acquire this. I've instead just deposited a little bit more, which was £250 this week. And if you're interested in signing up to Freetrade, you can get a free share worth up to £200 when you use my link in the description down below. However, the payments aren't going to immediately ramp up. I do have some bills to pay down, but then hopefully over the next few months coming up to the end of the year, I should start to really get a consistent amount of money into the markets because after all, pay your investments before you pay yourself. So before you notice it goes into your bank account, and have that immediately transferred out and into your investments. You'll thank yourself later in life. Games Workshop has been the notable faller for this week, and this is due to Jefferies, an analyst, cutting their price target estimates. Yes, this is quite a big move, although I think shares overreact as they dropped something like 7 to 8% on Friday's trading. They have slashed their price target down a fair amount. It was originally £132 to now £122.50. And they mention this is because there is a somewhat slight disconnect between Games Workshop and the Warhammer fanbase, and I completely agree with this. In fact, I almost hope that this analyst rating sort of provokes this idea to the management of the board, and hopefully they become more aware of it, because they have been very aggressive, very aggressive in the online community with their copyrights and really pushing away any content creators that were really interested in Warhammer. I think this is a negative overall because it was free advertisement. They're not really going to be stealing any revenue from you, so why is it that big of a deal? After all, I believe that what if you use that capital on the balance sheet instead of paying such a heavy dividend, invest that in some of those that are creating content for Warhammer and hire them under your own brand. Surely that would be an effective way to not only bolster the community, but also increase your longer term growth of your business. But there is definitely a disconnect going on, and there is some concerns. I was actually asked on Twitter if I'm going to be selling any of my Boohoo shares to buy any more Games Workshop, because Games Workshop is still my highest conviction stock. And I know in the past I've sold the likes of Team 17 and Ashton Group in order to really funnel more acquisitions in both Boohoo and Games Workshop. However, I'm not going to be selling any of my Boohoo shares. This is because both of these stocks I have a very high conviction in, and I'm not going to trade between my two biggest positions. I'm going to use any organic capital that I get from my income streams. I'm then going to push that into my investment portfolio and buy what I can. But I'm not going to sell one of the two positions to buy more of the other. I'm simply just going to be trying to time the market then. And I don't think that's sustainable. After all, I'm invested for the longer term, and I'm after the longer term returns. With the amount of stocks that I have, which are free, all it takes is one of them to do very well, and the other two to just even underperform, but that one stock should pull the portfolio up massively and put me ahead of line. Yes, at the moment I am massively underperforming the markets, but that could very soon change. Obviously, my portfolio being down 6.64% for the week is certainly pushing me even further downwards, but as long as I have capital and I'm able to continue pound cost averaging into the markets, I have no concerns. So did I buy any more Games Workshop this week? The answer is no. That's because I have no free capital available to do this. I also think that Boohoo is of a better value at the moment, but I will be keeping an eye on Games Workshop shares as I am very much interested in acquiring more where possible. If you'd like to hear more about my opinions on Games Workshop and Warhammer and why I'm actually very bullish on this, I'll leave a card at the top right of the video. And then we've also got the big news of the week. This is the tax budget, what they're going to be changing, and this is to do with the government. The government have announced that they're cutting business rates in half for retail, leisure and hospitality sectors. This was a scary piece of information for an online exclusive retailer, aside from the store they're going to be opening of Debenhams in Manchester, which is now Boohoo that owns it. Although it's not as bad as one may think. This is because a lot of the businesses that get this relief are small businesses, because the relief will be capped at 110,000 per business. So it's not like suddenly Primark going to be dominating because they've got lower tax rates. It just means they might get £110,000 back, which might not be a large amount, especially not for the likes of Primark. But it does mean that those smaller retailers should have enough to help them survive a little bit longer, and I think it's a good, fair balance. Obviously, there's still fears over a possible online sales tax, although I don't think we've had an announcement just of yet. But there is certainly some potential for taxes in the future, and yes, this could certainly squeeze the likes of Boohoo's margins even further. But don't forget, the likes of Boohoo, their margins are only squeezed because the freighting, the shipping, and cotton is at all-time high or 10-year highs in terms of prices. So at the moment, there's a lot working against them, and that's why I'm buying a lot more. But one retailer that might benefit from this a little bit is the likes of Dunelm Group. Dunelm Group is a stock that I hold in my SIP portfolio, which is separate to my ISA with all my growth stocks. In my SIP, or my self-invested personal pension, this is where I'm investing in dividend growth stocks. I really like Dunelm Group because I think they've got a lot of dividend growth potential in the future. Sure, they're not going to be growing as fast as Boohoo or Games Workshop for that matter, but I know that I could probably and reasonably say that they're going to be around in 20 to 30 years in some way or another, as long as they continue on with the strong management values that they have. And so I think it's understandable that I could invest in this stock, and I could expect to receive a dividend each and every year until then, unless obviously we have some major recession where they may need to suspend it for a couple of years, which I think is fair. And then we've got the likes of Amazon. You might think, okay, Amazon could certainly compete with Dunelm, Well, in small ways. The shipping and real deliveries of these larger furniture items are still going to prove difficult for Amazon to achieve, and they're likely just going to make better money on smaller items in general because they could fit more into a van, do more deliveries, and likely those smaller items have a higher individual value. So I really think Dunelm carves out its own market. Alongside with the cafes and all their stores, it does create an organic kind of community. I am interested. I'm going to go to my local Dunelm Group store just to see what it's like, get the vibes, pretend that I'm going to be furnishing up a house. Probably not convincing when I look about 13. They're probably going to think, why is he on about furnishing a house? Can he go back to playing with his Lego? But anyway, I get distracted. Dunelm Group is one I like. Their dividend yield is roughly 2.7%. It's fluctuating, so is the share price. And at first, obviously, when we had this business rate relief news, the shares of Dunelm pushed up a little bit. But for now, they're probably going to cool down. And as long as they cool down, I'm just going to keep acquiring small amounts each time. I now hold 9 shares of Dunelm Group. I bought 3 more this week. And this takes up 62.3% of my SIP. The rest of that is cash whilst I look for another stock to add to the balance as I slowly flesh out a smaller portfolio of diversified holdings that are all paying dividends. So this means I might be looking for 10 or so stocks to hold, and they'll all be paying a regular dividend income, and we can really see that compound. Dunelm Group is certainly the first on that list, but there will be more to come. As well as the fact that now that I am changing my income from weekly to monthly, my pension changes too. So I'm going to change and transfer my existing pension pot, put that inside my self-invested personal pension, and that should really increase the overall amount of capital I have available and really times the portfolio by 5 times. So this would be not as small of a portfolio and certainly a very interesting one indeed. We've also got the likes of Argo Blockchain. They made a video on Dickens County. Dickens County is one that is pretty interesting because this is where they're located in Texas. A lot of these videos seem to be a marketing tool, a way of them saying, hey, look at us as a business. They've kind of stopped trying to overhype the business, and I think the CEO has sort of learned that now. But it does seem that they're really trying to push an agenda that I don't think is that important, but they do have a lot of support in the community, and there is a good community outreach. After all, they're bringing business to their small town, and a lot of them are full of it. They love the idea. Like, some of the engineers that are involved in the product, they like the whole idea that there's 200 megawatts of electricity flowing to this potential future building. So there is certainly a lot of interest for this, and that is one thing that Argo Blockchain does have in their core. But this level of interest isn't really going to boost their profit margins because these people aren't just going to go in and spend money, because after all, it is a cryptocurrency mining company. At the moment, shares are really stagnating. They're not doing much. Bitcoin has been very wobbly in the last week, and Argo Blockchain has remained pretty stable, but then it never really followed the steps up with Bitcoin's growth. I'm hopeful, and in that way, it's probably quite a selfish way to be hopeful, but I hope that shares do remain low for a longer time. This gives a lot of people time to accumulate. Perhaps you bought at a high average price, and now you could just slowly and steadily add to the position. The reason I'm not adding, despite it being my furthest dropped position, that's because I don't want to overexpose myself to this. I think at the moment I'd rather put my money in my higher conviction stocks such as Boohoo and Games Workshop, and then put any additional top-ups into the likes of Argo Blockchain and slowly whittle away at that average share price. And I think over the longer term, this could do very well, providing that crypto, or Bitcoin in particular, does well too. But don't forget, with their business model, they are very flexible and adaptable, or even agile. This means that, say, Bitcoin no longer becomes the most profitable cryptocurrency that they mine, they can shift. Obviously, the machines might not be optimized for the other cryptos, but I'm sure there are other options that they could switch to in order to make the most profits. So it's not like they're just exposed to one commodity, like we would see a gold miner in particular be exposed to, because they couldn't just go, oh yeah, I've mined this gold, oh wait, now it's platinum. That's just not going to happen, but there is certainly potential. And when, obviously, if Bitcoin does drop, a lot of the other cryptos do usually drop, so it is a bit of a balance, and yeah, maybe it won't go too well, but there's always at least that option in the bull court to play. My portfolio has taken a beating this week. I have no concerns. As mentioned before, I will continue buying. Warren Buffett has a very good story on this, and he talks about owning a farm. There's a video on YouTube from Berkshire Hathaway's annual meeting of 2020. This is where he speaks about this, and it is a very knowledgeable piece of advice. The idea is that if you're buying a farm, you're going to value that business. You're going to know how much produce that is going to create each year. If you've got a farmer next door that is constantly shouting you prices every other day, and it's going up and down, just because he's offering you a lower price, it doesn't mean you have to sell, because you know the underlying value of your farm, you know how much you've paid per acre or share, and you know that over the longer term, it's going to continue producing cash, and that way you can continue holding. Unless, of course, obviously the guy next door offers you a ridiculously overpriced, insane valuation, at which point you may want to sell or trim back some of your farmland to give to that farmer. But again, I sort of digress from the main point of it. Thank you for watching, and if you're interested in my Argo blockchain stock analysis, the card is at the top right of the video. Have a fantastic weekend.